Okay, as we roll into the next portion of the lecture, we've talked about how one particular employee has gross earnings and you deduct all of their deductions. Now let's take a look at it from how this looks from the payroll department. As noted on this slide, an employer must keep a cumulative record of each employee's gross earnings, deductions, and net pay for the entire year. So you'll notice this is one particular employee, Michael Jordan, of all people. I don't know if he needs a part-time job, but nonetheless, all of his personal information is listed here. You see that he's married. You see his some more personal information, and of course, what he recorded on his W-2. It looks like he's got 2 exemptions. And if you see, you've got some pay periods prior, all the way on down, how many regular hours he's worked, how many overtime hours he's worked, his gross earnings, and then you start seeing all of the deductions, a total there to equal net, and even from a payroll perspective, what check number we used to pay him. For tax purposes, this allows to show how much was taken out for everything and what they create a W-4 then out of to show their whole earnings for a given year. This shows all of its employees. If I backtrack, this is particularly Michael Jordan. Here we see Patricia and Matthew, William, Robin, and then we see Michael Jordan again and another employee. So this shows all of them, and it's considered what's called a payroll register, showing all of the employees. You'll notice I've got things checked off in green. The earnings section minus the deductions to equal our net pay. And we even have our debit account of salaries and wages expense, certainly the largest expense a business has because paying your employees is expensive. The other neat part, because of this piece being it's the liability section of we owe all of these different tax authorities, we see exactly how much we owe FICA. We see exactly what's owed to state and federal. We see a charitable organization called the United Fund. Some employees participate in their union. So you see exact numbers where all these payables or liabilities in this case go to. Journalizing this. It's asking us to prepare the entry Academy company would make for the payroll ending January 14th. So if I go back, here's our payroll ending January 14th, and they're saying for all of the employees, what's our journal entry going to look like? You will see salaries and wages expense go up. Remember, this is a debit-based account, so when it's debited, it's an increase of $17,210. Where did that amount come from? Here is what they earned, or their gross earnings. That's Patricia, that's Matthew, that's William, that's Robin, that's Michael, and that's Lee. All of them. You'll see all of the payables line itemed out, FICA, federal, state, United Way, and union dues. Again, these numbers were derived from the totals through here. We do not get to keep any of those deductions. They definitely need to go to their appropriate taxing authorities, and they become payables for us because we owe these different taxing authorities this money. Take time to get your own notes and your own student notes updated based on what you're seeing there. We do, though, have a debit and credit disconnect because right now our debits do not equal our credits because this is the actual salaries and wages payable to our employees themselves. We haven't paid them yet. We have the expense of which is otherwise known as gross pay. We've got all these deductions, and we still owe, hence the payable, our employees, their net pay. This is just the journal entry to record the payroll. Notice this is for week ended. These employees are getting paid every week. This payroll accountant is doing this every single week, which gets to be very tedious. That's why you see a lot of businesses do a 2-week pay period. Here in Morris, for example, we only get paid once a month. So again, that's set up based on each employer or each industry. So this is what's owed and expensed out. Now let's actually pay the payroll. When it's time to pay this amount, because this is what we actually need to pay, they earned this. There's all these deductions. This is what we actually pay. You're actually going to see salaries and wages payable go down and cash go down too. Again, our largest expense that was a payable turned around and paid with the cash. So we first show the record of the payroll, all of the payables, including this one that we owe our employees. We turn around and deduct that right away and use cash to write checks. Speaking of writing checks, here's what a check would look like. If you have a part-time job, you see checks, you see pay stubs, different things like that. It's coming from our company, so it's a company check. Some are electronic, some are actually handwritten out. We are paying Michael Jordan his net pay. That was, of course, bundled into this cash going out. You typically don't see each employee's payable go down. You just see holistically the whole group. This is what I would call a pay stub, where it's showing a breakdown, again, who Michael is, his Social Security, his number of exemptions, when the pay is. You see gross versus net, a breakdown of all of the deductions, and then typically where is he sitting for year to date. If this is all electronic, which some businesses have what's called an automatic deposit, you wouldn't necessarily see this paper copy of the check. Oftentimes employers will still provide the pay stub. You can even opt out of that and have it just all electronically sent to you. The beauty of automatic deposit is you don't have to be there. For me, if payday is on a snow day and we're not at school, it's automatically there. If I'm gone home with a sick child, it's automatically there. If I'm gone on vacation, automatic deposit is automatically there, as its name implies. I would like to do a quick brief exercise with you. So if you can direct your attention to brief exercise 11.8. Looks like that is on the top of page 551 in your book. And I know there's space for you to do this in your workbook. Get all this cleaned up here as we continue our recording. Again, at the top of page 551, you see the little bio for the problem, 11.8. Data for Beth Corbin that was presented in what we just did in the previous recording is there. They want us to prepare the journal entries for Beth's pay for the period and then to turn around and actually pay her. So we have the liabilities occur, and then we turn around and pay her. Use January 15th for the end of the pay period. So Our salaries and wages expense, of course, was Beth's gross pay, what she earned, not necessarily what she took home. In Beth's case, we had a few payables. We had her FICA that was payable and also her federal income tax that was payable. Those payables are increasing because although we didn't pay Beth those, we have that extra money. We certainly don't get to keep that $58.14, nor do we get to keep the $95. They need to go to each of the taxing authorities. Another big payable here is Beth. Salaries and wages payable, what we know is her take-home or her net pay, we owe her. And so salaries and wages payable is also increased. All of these payables normally have a credit balance, so with a credit, that means they're increasing. As we move on to Part B, because January 15th it happened, and then also on January 15th we paid her, you'll see what happened here with this payable actually go down. Remember, a credit balance increases it, so if we debit, it's like we're taking $606.86 minus itself, and then we're actually going to see a reduction in cash because we paid her. Had Beth not had automatic deposit, we would have actually wrote this check. With an automatic deposit, it all is directly transferred right to her bank account. That's where I'm going to stop the recording, and I'll come back to you for yet one more recording with the expectations for the remainder of the day and the next day.